As the host of a real estate podcast, I get a lot of questions. It's a very wide spectrum. And what I get is questions on how should I get started? What should I buy? But lately I've been seeing one particular question coming up time and time again. And it's, seeing this question so often, clearly it's on people's minds. And that is, am I expecting another recession? In this video, I'm going to explore, is another recession and a property crash inevitable? Now, before we get started, we want to probably agree on a couple of definitions and what is the technical definition of a recession? Now, according to ChatGPT, a recession is defined as, and let me read this to you, a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. However, a more simplified and frequently cited rule of thumb is that a recession occurs when there are 2 consecutive quarters of negative growth in GDP. If we're looking at negative growth in GDP, is the Irish economy suffering from a recession? Well, no, actually, it is absolutely nowhere near. According to the Central Statistics Office, the CSO, in 2022, Ireland's GDP grew by 9.4%. This effectively makes us, the Irish economy, the strongest performing economy in the entire EU. So strong, in fact, that Ireland's performance single-handedly pulled the entire EU out of recession last year. According to wisevoter.com, which is a US-based think tank, I guess you'd call it, Ireland is now ranked as the 3rd richest country in the world when measured by GDP per capita. And believe it or not, that ranks us above both Switzerland and Norway. And we are just outside of both Bermuda in second place and Luxembourg at the top. Needless to say, with this kind of economic performance, the likelihood that we're going to experience any kind of recession anytime soon is really, really slim. But if we go and think about this in a more broad and general sense, the general economy, there's definitely signs that the economy is starting to show some struggles and that there are some challenges. And why is that? Well, primarily it is caused by inflation, the cost of interest rates and the cost of living in general. People are definitely feeling it in their wallets, and they are adjusting their spending accordingly. What has caused inflation? Well, there are multiple causes for it, and it stems from the lockdowns. COVID-19 created this lockdown and everyone was at home, so nobody was spending on restaurants, on holidays, and that meant that there was a lot of money saved up, but B, there was a pent-up demand for these things. People weren't able to do any of this stuff for a long period of time. So when it eventually came back, everyone felt like, let's go out and effectively party. Now, in addition to that, there was government stimulus to basically prevent an economic crash at the time during lockdowns. Because if you had all of these people being made unemployed at the same time, and if there was no basically safety net there to prevent them from all starving, you were going to be in a situation where there was mass unemployment. Now, those are 2 factors that caused it. But then to add, insult to injury, we had the Russian invasion of Ukraine back in February last year. And what that has done is it has driven up oil prices. Everything was starting to kind of calm down. Then Hamas attacked Israel just in the last week or 2. And what that has done is it has made an awful lot of international commodity traders very, very nervous. Anytime there is any kind of prospect of a war in the Middle East, it drives up oil prices. So what has happened prices are rising again, certainly at the petrol pumps, but we already have, a fall in inflation everywhere else. But now suddenly we're looking back at oil prices increasing. This will definitely feed into inflation. Whether or not it has a major impact on inflation, that's the bit that remains to be seen. If it does, there is a risk that the central banks will have to respond again. In other words, what does that mean? That means that interest rates could, believe it or not, increase further. Now, while most central banks in recent times have been indicating that they've reached a peak in their interest rate increases, and the only question really was that they were going to pause their increases, and it was probably going to sit at a kind of plateau for a period of time. So the question really was, how long can you hold out for? But make no mistake, if inflation starts to rise again, there is no question that central banks will have to respond and will have to resume interest rate increases to counter it. That would be a disaster for economically speaking, because consumer sentiment is already on the edge. That's going to push it further, and that would in turn impact consumer spending. And when consumer spending is impacted, then it filters down through the economy, and you start to see investment sentiment impacted, which of course filters down into the property market. Now, whilst this scenario may be unlikely, it is by no means an impossibility. And as an investor, I would strongly recommend that you eliminate the term impossible from your vocabulary, because, and I mean that both from a positive and a negative standpoint. If you believe something bad is impossible, it sets you up for potentially unpleasant surprises in the future. But then equally, believing that something good is impossible because it's either difficult to achieve or very unlikely, that would be a poor mindset to start out with. Further interest rate increases are certainly not impossible, but one should not take the view that making money in a difficult market is impossible. Remember, opportunities can be found pretty much in any market at all. You just have to be actively looking for them, and you have to adjust your tolerance for risk, and you need to price the assets accordingly. The majority of investors will stop investing, will stop looking at the market altogether when they perceive it to be a risky time. If you think about it like that, that would mean that there is a major opportunity for the minority of investors out there who may be contrarian in the way they look at the market. And so this presents an opportunity. In 2011, if you go back after the 2008 crash, market was really just depressed and it went down for several years. And in 2011, there was so few investors in the market that the Irish government had to actually bring in stimulus to actually create transactions in the property market. And what they did was they introduced the capital gains holiday, and that was for both companies and individuals, and that ran for 3 years from the very end of 2011. So it was basically for all of the calendar year 2012, 2013 and 2014. And the only criteria really was that the assets had to be held for 7 years before you could sell them again. But you didn't pay any capital gains tax at that period of time. And a lot of people made a huge amount of money when they did that. So remember, risky time does not mean stop investing. It just means adjust your posture and adjust for risk. What this means is you could make significant discounts in the asking price. When you're making an offer, like, don't take the asking price, go significantly below the asking price. Now, if the seller does not have to accept your offer, and sometimes I've seen that when you make a low offer like that, that the seller will actually feel insulted. But there will be some out there, they may be a small number, but there will be some out there that will actually accept your offer. And you might be saying, like, why would somebody accept a real lowball offer? Well, maybe they have overextended themselves. Maybe they have their back to the wall. Maybe they're struggling with payments as it is. They took on too large of a mortgage, or they're worried about future rate increases, or perhaps simply their circumstances have changed. And with their circumstances changing, they've decided that they need to get out of the market. Unless you are actually making offers in the market, looking for things, it's going to be very hard for you to find those deals. That's one of the reasons to go out and look for them. Assuming you can fund them, of course, because banks are tightening their belts and making their criteria for lending a lot more difficult. So let's get to the question like, am I expecting a recession? I think what they're really asking is, am I expecting a property crash? And a recession and a property crash are two very different things. And if, like me, you are in the commercial office sector, then you might be forgiven for thinking that we're already deep in the middle of a property crash, because it is bloody tough out there, I can tell you. But I think what you probably mean is a housing crash likely? And could the housing market crash like it did back in 2008? My response is no chance. And like you might be saying, like, why are you so certain? Well, don't get me wrong. I'm not saying the prices are not going to fall. I'm just simply saying that what we saw in 2008, the 2008 crash, was entirely different. It was fueled by rampant speculation. And you've got to think about that market then compared to the market now. Back in 2008, you had easy credit, and that the credit was given out by very, very poor lending criteria. I remember borrowing money, and it was just literally pick up the phone, ring, and you could have money straight away without any real pushback. Also, you had 3x the volume of housing output. Today's housing demand outstrips supply by a full 2x. We are at maximum capacity. Like, we cannot produce any more houses than we are at the moment, and we are still only producing 30% of the number of units that were built in the year 2007. So the big issue facing this market is affordability. Demand and supply are not the issue. That is different to 2008. In 2008, supply was outstripped by demand, but demand was being driven not by necessity but by speculation. Interest rates are pushing people to the brink, and they're also pushing banks to put pressure on people. People no longer qualify for the same property that they did just 1 year ago. Having said that, the central bank did increase their criteria in lending. It used to be 3.5 times your income. Now it's 4 times your income. But even with 4 times your income, the rates have been pushed up, so your affordability has actually gone down. People also have to contend with the cost of everything that has gone up in the interim. And so, I don't know, if you're trying to fund a major purchase like a home or something like that, you'll obviously go to a lot of extremes in order to try to afford to do that. But if you're looking to speculate on an investment property, how far are you prepared to stretch yourself on that? It's not a necessity compared to, say, feeding your family or putting a roof on their head or whatever. So affordability is the risk, not supply, not the demand and the imbalance between the two. If rates fall, the buying frenzy will continue because the demand is there and it's absolutely off the charts. Our population is at the highest it's been in 175 years, and therefore we just do not have the number of houses in the market for the numbers of people. And we also have net inward migration. All of this is going to mean that rates, what happens to rates is going to be the single factor that moves the market up or down. If you found this video useful or helpful in any way, please do comment below. Or indeed, if you think I'm wrong, if you think I'm way off in this prediction, then be sure to let me know in the comments below as well. I do plan to make a video on the cause of the current supply-demand imbalance. Until next time, remember patience and discipline. Stay grounded. I'll catch you in the next one.